The global debt crisis explained why every country owes trillions. Every country in the world, from the richest to the poorest, owes money. The United States owes over $34 trillion. Japan owes more than twice its GDP. Even developing countries are drowning in loans. But have you ever stopped to wonder, who do they owe all this money to? And how did the entire world end up in debt together? Welcome to Vectorlog, where we break down the complex world of money, markets, and the global economy in simple terms. Today, we're diving into one of the biggest financial mysteries of our time, the global debt crisis, and why every nation seems to be borrowing endlessly. Let's start with the basics. What exactly is national debt? When a country spends more money than it earns from taxes, it needs to borrow the difference. That borrowing creates debt, just like when you use a credit card or take a loan. Governments issue bonds, essentially IOUs, which are bought by investors, banks, and even other countries. The idea is simple: borrow now, pay back later, with interest. This can work well when used responsibly. Borrowing can fund roads, schools, infrastructure, and growth. But when spending outpaces income for too long, the numbers start to spiral. You might think, well, if everyone owes money, who are they owing it to? Here's the twist. Countries owe money to themselves, to each other, and to private investors. For example, much of the U.S. debt is actually held by Americans through pension funds, mutual funds, and the Federal Reserve. China and Japan also hold large portions, but not nearly as much as people assume. So, global debt isn't just a story of countries versus others. It's an interconnected web of obligations. Think of it as the world borrowing from the future, promising tomorrow's money to pay for today's problems. But how did we get here? Let's rewind to history. After World War II, the world rebuilt itself through massive borrowing. The Marshall Plan, government spending, and infrastructure projects kick-started global growth. Debt seemed like the solution to everything, and for decades, it worked. Then came the 1970s and the oil shocks. Prices soared, economies slowed, and borrowing skyrocketed to keep countries afloat. By the 1980s, the debt crisis hit Latin America, and developing nations struggled under loans they couldn't repay. The 2008 global financial crisis made it worse. Central banks cut interest rates to near zero, making borrowing cheaper than ever. Governments borrowed even more to stimulate economies and bail out industries. And just when the world started to recover, 2020 happened. The pandemic forced massive spending, trillions in relief packages, health budgets, and economic support. Global debt hit an all-time high, over $300 trillion. That's roughly 3 times the world's total GDP. But wait, if every country owes trillions, why haven't we run out of money? Because the system keeps moving. Governments continuously roll over their debt, issuing new bonds to pay off old ones. It's a never-ending cycle. As long as investors believe a country can repay, the system works. The problem begins when confidence fades. When investors worry that a country might default, interest rates rise, borrowing gets more expensive, and suddenly, debt becomes a trap. We've seen this play out in Greece, Sri Lanka, Argentina, and many others. One crisis can trigger another, creating a domino effect across markets. Now, you might wonder, is debt always bad? Not necessarily. Debt can fuel economic growth when used for productive investments. Think of it like using a loan to start a business versus to throw a party. One builds assets, the other builds problems. For example, borrowing to build renewable energy projects, infrastructure, or education can create long-term returns. But borrowing to fund political promises or consumption, that's where trouble starts. The real danger today is how fast debt is growing compared to economic output. Many nations are now spending more just to pay interest on their debt than on healthcare or education. In the U.S., annual interest payments on federal debt could soon exceed military spending. In developing countries, the situation is worse. Debt payments are crowding out social programs. And here's the alarming part. A large portion of global debt is denominated in U.S. dollars. That means when the dollar strengthens, it becomes even harder for other nations to repay. So, the world is stuck in a loop. Countries borrow more to service old debt, leading to even higher future debt. But let's pause here. If governments keep printing and borrowing endlessly, why hasn't the system collapsed yet? because modern economies run on confidence. As long as people believe their money holds value, and as long as countries continue to trade and pay interest, the illusion holds. But if that confidence breaks, everything can unravel fast. We saw glimpses of that during the 2008 crash, the 2020 pandemic panic, and even recent bank collapses. The global financial system today is a delicate balance of trust, liquidity, and leverage. Now, let's talk about who benefits from this debt-driven system. It might surprise you, but debt can be profitable. Banks earn interest, investors earn yields. Governments gain the power to spend beyond their means. And central banks, like the Federal Reserve, can influence markets through money creation and rate policies. Debt has become the lifeblood of the global economy. But like any lifeblood, too much or too little can be dangerous. So what happens if countries start defaulting? Defaults can trigger financial contagion, spreading fear across markets. Currencies fall, credit dries up, and investors flee to safe havens like gold, U.S. treasuries, or even crypto. We've seen this movie before, from Argentina's collapse to Greece's bailout. And while developed nations have stronger systems, the debt numbers are starting to look eerily similar. But here's something important to remember. Debt itself isn't evil, it's a tool. It can build nations or break them depending on how it's used. The global debt crisis isn't just about numbers, it's about priorities. Are we investing in growth and innovation, or just patching over problems with borrowed money? So where do we go from here? Some experts argue we need a financial reset, a restructuring of global debt, fairer lending, and sustainable growth. Others believe technology, productivity, and innovation will eventually outpace debt growth. The truth probably lies in between. The global economy has evolved, and debt has become a built-in feature, not a bug. But even then, we must ask, how long can the system stretch before it snaps? At the end of the day, global debt reflects our collective choices, as nations, businesses, and individuals. We all borrow from the future to make life easier today, but the bill always comes due. Understanding debt isn't just about economics, it's about responsibility, because whether you're a government or a household, the rule is the same. Borrow wisely, spend carefully, and never forget that every dollar today is a promise to tomorrow. Thanks for watching Vectorlog. If you found this video insightful, don't forget to like, subscribe, and share it with someone curious about how the world's money really works. Stay tuned for our next episode, where we will break down another big mystery from the world of finance. Because here at Vectorlog, we make sense of sense.